Hello and welcome. You're watching To The Point. How credible is Sushma Swaraj's commitment to seek the Supreme Court's permission to move the International Court of Justice in the Saurabh Kalia case? Or is it both irrelevant and misleading? And is she only raising the Kalia family's hopes to eventually dash them? That's the discussion in part 2. But first, the Reserve Bank of India has cautiously reduced interest rates while expressing concerns about both inflation and growth. So does Governor Raghuram view the state of the economy somewhat differently to Finance Minister Arun Jaitley? And secondly, is the macro picture bright whilst perturbing micro problems continue? That's our first discussion tonight. And joining me now to discuss the RBI Governor's statement and the state of the economy is the Managing Editor of the Business Standard, Rahul Jacob, the Chief Economist of the Aditya Birla Group, Ajit Ranade, the well-known author and columnist Gurcharan Das, and the Founder-Chairman of Renew Power Ventures, Sumant Sinha. Mr. Sinha, let's start with what the RBI has said and done, and then later on talk about the state of the economy. The RBI Governor has cut lending rates by 25 basis points, calling it a Goldilocks policy, which he says is neither aggressive nor conservative. Do you agree with his interpretation of what he's done?
Well, you know, the Goldilocks economy is perhaps the wrong term to use. I think he's ended up displeasing everybody because a 25 basis point rate cut is neither here nor there. It does not really do anything to the economy in terms of causing lending rates to really get lower by an amount that actually has an impact. And, you know, along with that, the guidance that he's given about the future of the economy does not look very good either. And that is the reason why you had, or partly the reason at least why you had markets selling off the way they did, and why suddenly the prognosis for the Indian economy is perhaps weaker now than it was before the credit policy announcement happened. So I fear that, you know, Goldilocks,
Yeah, carry on, please finish, go ahead.
No, the only point I was making was, you know, neither too hot nor too cold seems to imply that it's perfectly fine. But unfortunately here, not too aggressive, not too cautious means actually not very much.
Rahul Jacob, let's look at that very interesting perspective that Mr. Sinha has given. And let's start with the fact that at least initially the governor seems to have been guided by his fears of inflation. Now, he began by saying that inflation at the moment is within comfortable limits. But he pointed to 3 factors which worry him and suggest that inflation could go up in the medium term. And those 3 factors were a weak monsoon, pressure on crude prices, and what he called volatility in the external environment. Do you agree with his midterm concerns that inflation could go up? And therefore, do you think a 25 basis point cut was the best he could do?
Yes, absolutely. Because in fact, this 25 basis point cut comes after 2 successive cuts in the last few months. So it's actually, we're talking about a 75 basis point cut in accumulated. The stock market's reaction is rather exaggerated. What Dr. Rajan is playing here is a long game to slay inflation once and for all, in as much as you can do that. And there are concerns about food inflation. The governor's comments, the interest rate cut was followed almost within hours by a revised forecast on the monsoon, which revised it downwards. It's now thought to be 88% below normal, which would have an impact on food prices. China's stock market could crash tomorrow. The oil prices could go up. There are a lot of external factors in a way that there haven't been in previous years. So I think he was right to stop at 25 basis points.
Ajit Ranade, let's look at the flip side of that very interesting equation that Mr. Sinha drew for us. Now, the governor said that Indian growth and Indian recovery was weak, and he pointed in particular to weak investment levels and poor corporate results. And as a result, he's lowered his own GDP forecast from 7.8 to 7.6. But then, in that case, shouldn't he have gone for a bigger rate cut than just 25 basis points to kickstart recovery?
You see, his most dominant concern actually at this stage is the inflation fears or the risk of inflation in the near future. As you yourself mentioned, there are 3 possible sources. The oil prices have gone up by 10% in the last 1 month. In fact, the rupee has depreciated by about 2% in the last 1 month. and the increased the chances of a deficient monsoon, which will impact food inflation. On the other hand, the growth numbers are 7.6 nobody can say is a deficient number. So growth concerns on the basis of the top line or the macro numbers don't look, although these growth numbers are not reflected adequately in the micro reality. When you look at the index of IIP, index of industrial production, 70% of which is manufacturing, that has grown only to about 2 or 3% in the last 1 year. You look at export growth, you look at credit offtake, you look at, in fact, electricity production, which is a proxy for industrial production. All those numbers are looking weak, but still on balance, I think the governor is focused, continues to remain focused on inflation fears, because I think that affects everybody. And it's very important that we don't let inflation come back above the target levels again.
So very quickly, Mr. Ranade, you're not disappointed, leave aside disheartened that the rate cut is only 25 basis points?
Yeah, Mr. Jacob also said that this is the third rate cut in the last few months. So cumulatively, we have had 75 basis point cuts, which is 0.75%. The actual rate cut which has been passed on by banks to their customers, for example, what is called the base rate, which is the basis of the housing loans, is barely 15 or 20 basis points. So in fact, where is the pass-through? We should have seen a much bigger pass-through. 75 must translate into 75, at least 60 basis points cheaper loans for. So it's actually the bottleneck is in the transmission system of the interest rates. It's up to the banks, and banks are constrained because of high levels of distressed assets, of NPAs. So they have margin pressures. So I think the problem lies in the transmission system.
Mr. Gurcharandas, there were two messages in a sense that came out very strongly from the governor's press conference today. Firstly, his fear that inflation could inch up, maybe do more than just inch up. And secondly, his deliberate lowering of the growth forecast. He was particularly skeptical of the 7.5% claim for Q4 of last year. These two messages certainly didn't cheer the stock market. What did they do for you?
Well, I must tell you that I feel disappointed, and I have felt disappointed for a whole year at the Reserve Bank's conservative stance. The need of the hour is for India to create an industrial revolution so that we get the jobs back in our economy. And frankly, today, one of the major factors constraining that is consumer demand. Consumer demand, unless that demand picks up, the capacities, the companies will not expand capacities. If they don't expand capacities, you won't get jobs and you won't get growth. Now, if to create that industrial revolution, or certainly you could go by an infrastructure route, the fact is today's interest rates are too high for infrastructure spending or for creating an industrial revolution. So I personally am very disappointed at the way, at the conservative way. And frankly, when it comes to these fears, a lot of things could happen in the world. You could have a nuclear war in the world. And the reality of the matter is that the government, which is so keen on a rate cut, they should reassure Mr. Rajan that there are supply-side responses possible against food inflation. You can fly in food in a global economy. They sold 15-20 million tons last year. They could do that again because we have the reserves to do that. And so I firstly feel we should fight inflation through supply responses and let monetary policy be there to drive up the jobs, to drive up growth, which is the need of the hour.
Suman Sinha, let's move beyond the governor, move beyond his concerns to how you view the general state of the economy. Most people see a sort of paradox, or maybe I should put it more strongly, a contradiction, because on the one hand, GDP has grown by 7.3% last year. India is proud to claim to be the potentially fastest growing economy on the world. And yet, on the other hand, as the Business Standard highlighted yesterday, sales across some 1,700 companies are their lowest for 2 years. Profits have fallen by some 7.45%. Core sector growth rates are falling since November. What do you make of this strange contradiction?
Karan, I think the GDP numbers are not reflective of where the economy actually is at today. And so therefore, if somebody looks at the GDP numbers and says, look, we're growing at 7.5%, and so therefore if we don't reduce the interest rates as much as we should, what's the harm because the economy is doing well? I think that's the wrong argument to make right now, because we're not growing at 7.5%. And I don't know how strongly to say this, but the reality is it feels like we're at 4.5% to 5%. If you look at all the numbers, even if we're at that number, one can sort of argue. As you pointed out to some numbers, and everything is reflective of a very poor sort of industrial growth environment in general. Consumer demand is ticking down, industrial growth has been very poor, the investment cycle is not picking up, banks are not able to lend. Something somewhere needs to break this logjam. Otherwise, we're going to just trundle along at the same, what I would say is a 4 to 5% sort of growth level, notwithstanding what the actual numbers say. And therefore, to me, the only way to do this, while the government is busy fixing so many sectors, is really for the interest rate side to kick in and help the government and help the economy. But I think, as Gurcharan rightly said, there are so many things that can go wrong in the economy. But you can't just to protect your own position, you can't take the most conservative approach and thereby not address so many other issues that need to be addressed. I think there should have been a 50 basis point reduction. I think any conversation with any bank would indicate that nobody is passing on this reduction in the interest rates. And so therefore there isn't a 75 basis point reduction, it's like a 30 basis point reduction, which has zero impact on the actual investment cycle.
Jacob, I'm going to come back once again to the sharp contrast that I can see between the macro picture as you look at it and the micro picture. On the macro front, and Mr. Jaitley rightly takes pride in this, the fiscal deficit has been very comfortably contained. The CAD is down to just about 1%. Inflation is down to very comfortable levels, under 5%. And growth, if you accept their new growth figures, is soaring at about 7.3%. But the micro picture suggests a very different world. Corporate sales and profits are under stress. Investment is adamantly refusing to pick up. And several sectors like textiles, realty, cement and metals are in fairly poor health. And exports, of course, are slumping. So you've got really two opposite pictures, whether you look at macro, which is positive, and micro, which is stressed. How do you make sense of that?
Well, if you look at, we live in a very confusing world at the moment. The numbers literally don't add up in India anymore, and that's part of the problem. But the fact is, on interest rates, if you adjust for inflation, interest rates are actually quite low compared to where they were between 2003 and 2008. One reason banks are at some level unwilling to lend is they're sitting on very, very high non-performing assets. On the other hand, companies are sitting on massive overcapacity. So this idea that we're going to have an industrial revolution simply by cutting interest rates is a little bit daft. We actually have some major reforms we have to do. We have to get the infrastructure sector working. We need a bankruptcy code. There are lots of major reforms. We need better regulators, but it seems to serve a large section of industry to keep on about Dr. Rajan cutting rates, which I think simply doesn't add up to the facts before us. I mean, the interest rates really, if you adjust for inflation, are not that high. They are much lower than they were between 2003 and 2008, when growth rates were higher and the economy was booming.
Ajit Ranade, you were much more supportive, understanding and in line with the governor's thinking than perhaps Sumant Sinha and Gurcharan Das. Let me ask you a blunt question. Given what's happening at the moment to investment, which is not picking up, job growth, which is not growing, exports, which are slumping, credit offtake, which is very low, corporate profit and sales, which are stressed in agriculture, which has barely grown by 0.2%. The blunt question is this: do you believe that 7.3% GDP growth figure? Leave aside the 7.5 for Q4.
Well, the chief economic advisor to the government of India, to the finance ministry himself, has said that I still don't understand the numbers myself. So, if he himself is finding it puzzling. But leave aside those macro number, I completely agree with what Mr. Gurcharan Das said, that the need of the hour is to revive growth, whether it's at 7.5 or, as Sumant said, it feels like 5.5. And I think it's not going to be led by consumer spending right now, because we are looking at very meager job creation. It's going to be led by infrastructure spending. And remember, the government has enjoyed a big bonanza, a windfall gain due to a sharp reduction in oil prices from $100 to perhaps $50, which translates into a gain of 60, 70, 80,000 crores in terms of savings on fiscal deficit and the current account spending. That should translate into very big spending and a big push on infrastructure, which in turn will kick in, which crowd in, not crowd out private investment. That's what we are hoping for. That will support a whole range of industries, from steel and cement and construction. And this is the need of the hour. Another example of this is we have coal prices which have gone down hugely. Imported coal, we now actually are facing a situation of surplus coal, but the coal is stuck in coastal ports because it's unable to be evacuated to go to the power stations because of inadequate rakes. So we are looking at railway infrastructure. We need to invest hugely in railways as well. So I think this recovery has to be led by the government, whether it's in terms of infrastructure spending or also a huge stimulus, recapitalization of the banks. Mr. Jacob mentioned how banks are under stress. The banks, 75% of banking is in the public sector. It requires capital infusion. It requires a support. Banking is the problem that needs to be focused on. So I think we need growth, but it's going to be led by infrastructure and capital infusion.
Mr. Gurcharandas, that answer from Ajit Ranade reminds me of what the Economic Times said very forcefully in their leader yesterday. At a time when industrialists, and you in particular, are hoping for bigger and larger rate cuts and disappointed they haven't happened, this is what the Economic Times said. Investment and growth revival depends not on minor tweaks to interest rates, but on policy action to relieve infrastructure players of their debt burden and the creditors of their bad loans. And then the paper adds, it's up to the government to act now on this front. Actually, what Mr. Ranade was saying, and I want to ask you if you agree, is that the government hasn't done enough action on this front. Would you agree?
Well, I think you need both, because you do need the empty flats that are there. You need people to be able to take out loans at a reasonable price to fill those flats, to create that demand. But of course also you need infrastructure spending that Ajit just talked about. And the fact is that today the rates are too high for any investment in infrastructure. So you need to do both. I don't think it's neither or this. There's a lot of things this government needs to do. It needs to follow through on the ease of doing business. A lot of these things will come in. And so it's not either or. You need everything. We are at a very low point right now, and we need those jobs very, very desperately.
Suman Sinha, let me put this to you. From the standpoint of a business person, a man who believes that investment cycles need to pick up and they haven't, what do you believe Mr. Jaitley should do that he hasn't done or hasn't done enough of that would take care of the growth problem and the investment problem?
I think one thing, Karan, is, as everybody has talked about, is the financial sector. I think bank recapitalization, whether through the budget directly or allowing banks to raise funding through the capital markets, I think is very important. I think that will then allow banks to lend more. Today they're just not lending sufficient amounts. And I think to Ajit's point about infrastructure being kicked off, interest rates are so high right now that, we are borrowing at 11 to 12%. It makes it, it just raises the price in the entire economy, because ultimately there is a cost to capital, and if the Reserve Bank of India keeps that cost of capital high, then that feeds itself into everything else in the economy. And infrastructure services then start costing more, which then of course leads to its own level of inflation. So coming back to what Mr. Jaitley needs to do, I think, as I said, one is bank recapitalization. The second is the government in general needs to carry on fixing sectors one after the other. They are trying, but I think it's, the hole is very deep, and therefore it's taking longer. I think perhaps on the road building front, on the infrastructure building front, they have to release more money and get the public investment side kicked off. while at the same time trying to make it easier for private investors to come in and make investments.
Okay.
Now, unfortunately, things like MAT and all of those things ultimately mean that capital from overseas becomes a little bit scarcer, and that prevents private capital formation from happening, whether it's in investment side, in the investment side or on consumer side, whatever. So I think those are some of the areas that really need to be looked at much sharper.
Rahul Jacob, I want to come back to something slightly different to what I've asked both Gurcharan Das and Sumant Sinha. I sensed, as I heard the governor this morning, that on two critical issues, firstly inflation and secondly on growth, his view is very different to that of Mr. Jaitley. The governor was more concerned about problems that could push inflation up. He was concerned about problems that are keeping growth below its potential. Mr. Jaitley and the finance ministry are much more robust on both. Do you think that what lies behind this is the possibility, maybe it's only the possibility, that they view the state of the economy significantly differently from each other?
I think this is slightly overplayed because it's the role of a central banker to worry about things that might go wrong. I mean, the famous line about pulling away the punch bowl just as the party is getting going applies to central bankers for a reason. I think Dr. Rajan is particularly concerned about inflation. He's laid out his intentions with inflation targeting. And let's not forget, one reason demand is low is because people have suffered successive years of 10% inflation. That's effective to a pay cut of that equivalent amount. No wonder they're not spending. So actually, even as the economy has come back slowly, the consumers are waiting to see that inflation isn't going to come back and bite them. And then they will start spending. So we just have to be a little bit more patient. We have a gradual recovery underway. I don't think the government, I mean, the world over, governments see the economy in rosier terms, perhaps, and central bankers are paid to worry about things that might go wrong. That's simply how it is.
Ajit Ranade, let me put that same issue to you, but in slightly different terms. Do you think our governor, given the present state of the economy, needs to be bolder and less concerned about, say, the possibility of inflation creeping up?
No, I don't think so, because one of the things that has happened under his watch is that the currency has become stable, inflation has come down but not as much as their target, and we have had huge amount of inflows. In fact, the month of May was the first time that we had outflows of foreign money, and that is probably related to the tax and MAT issue. So I would say, in fact, it's not about, the governor is doing his best, I think, and this is his primary job is to protect the value of our money. I would say, if you ask me what should Mr. Jaitley do, focus, I think, on the financial sector, on the banking sector in particular. I would make a specific suggestion. Appoint a high-level committee of 3 senior retired bankers directly accountable to the minister, not to the bureaucrats, and empowered to tackle the top 100 NPAs or distressed assets in the next 100 days, and empowered to take decisions about haircuts, about equity infusion, without fear or any, repercussions in terms of CVC and all that. And that's how you have a huge Gordian knot of about, I don't know, 6 lakh crores of NPAs, and that's the locked up capital. That is not released. I mean, credit offtake is at an 18-year low or something like that, 9% growth. So that's, I think the key priority should be that. That's what the government should kickstart. All
right, Mr. Ranade, let's hope Mr. Jaitley is watching. Let's hope he also accepts your advice, because one way of making sure that industrialist investors support the tough action that's necessary to clear that Gordian knot of NPAs is if industrialists give that advice themselves. My thanks to all my 4 guests for joining me.